Ind AS 36, Impairment of Assets. This standard applies to all assets other than inventories. For inventories, Ind AS 2 is applicable. Contract assets. For contract assets, Ind AS 115 is applicable. Deferred tax assets. For deferred tax assets, Ind AS 12 is applicable. Assets arising from employee benefits. For employee benefits, Ind AS 19 is applicable. Financial assets that are within the scope of Ind AS 109. Biological assets relating to agriculture activities measured at fair value less cost to sell. For that, Ind AS 41 is applicable. Non-current assets are disposal groups classified as held for sale. For that, Ind AS 105 is applicable. This standard also applies to financial assets classified as investments in subsidiaries, associates, joint ventures, for which Ind AS 110, Ind AS 28, Ind AS 111 is applicable. Identifying an asset that may be impaired. When an asset will be impaired, an asset is impaired when its carrying amount exceeds a recoverable amount. Therefore, impairment loss formula is impairment loss equals to carrying amount less recoverable amount. Measurement of recoverable amount. The recoverable amount of an asset is higher of fair value less cost of disposal or value in use, whichever is higher. We will get a recoverable amount. How to calculate fair value less cost of disposal? Fair value, it is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It will be determined as per Ind AS 113 fair value measurement. What is cost of disposal? These are incremental costs directly attributable to the disposal of an asset. Example of cost of disposal is legal cost, stamp duty, cost of removing the asset, etc. Value in use. How to calculate value in use? Value in use is the present value of future cash flows expected to be derived from an asset. Primarily, two key decisions are involved in determining value in use. First one, estimation of expected future cash flows. Second, discount rate to be used. Value in use, expected future cash flows. It includes cash inflows from the continuing use of the asset, cash outflow that are incurred to generate the cash inflows, including cash outflows to prepare the asset for use, net cash flows for disposal of the asset at the end of its useful life. While calculating expected future cash flows, following to be ignored. Future cash inflows or outflows expected to arise from a future restructuring plan to which entity is not yet committed. It should be ignored. Discount rate. Discount rate should be pre-tax market rate. Guidance on foreign currency future cash flows. If any cash flows arise in foreign currency, then such cash flows are to be converted to present value using discounting factor of foreign currency, and such present value is converted into rupees, home currency, using spot rate. Spot rate means a rate on the date of value in use calculation. Circumstances in which it is not necessary to calculate both fair value less cost to sell and value in use, or it is not possible to estimate either fair value less cost to sell or value in use. There are three circumstances where both fair value less cost to sell and value in use need not or cannot be calculated. If either first situation is if either fair value less cost to sell or value in use exceeds the asset's carrying amount, then asset is not impaired and it is not necessary to estimate the other amount. Next, second situation, no reliable estimate of fair value less cost to sell is available, then recoverable amount equals to value in use. Vice versa is not applicable. That is, if value in use cannot be estimated, then fair value less cost to sell is not equal to a recoverable amount. In that case, we will say that a recoverable amount cannot be estimated. Third situation or third circumstances, can estimates, averages, and shortcuts be used to compute fair value less cost to sell or value in use? Such shortcuts may be used if they provide reasonable approximation. Next, recognizing and measuring an impairment loss. How to calculate impairment loss? Impairment loss equals to carrying amount less recoverable amount. Treatment of impairment loss. Assets carried at cost model. In such a case, impairment loss will be transferred to P&L account. If assets are carried at revaluation model, then same treatment of revaluation loss will be applied to impairment loss. That is, if any revaluation surplus exists, then recognize impairment loss in OCI to the extent of revaluation surplus. And if loss exceeds surplus, then transfer the excess loss to P&L. If no revaluation surplus exists, then transfer the impairment loss to P&L account. After the recognition of impairment loss, the depreciation should be charged on assets revised carrying amount. That is carrying amount after impairment loss, less its residual value, if any, on a systematic basis over its remaining useful life. Next, when to conduct impairment test. That means frequency of impairment testing. Frequency of impairment testing. Whenever there is an indication that an asset may be impaired, refer indications of impairment. Following are the indications of impairment. Indications are of two types: external indicators, internal indicators. So indicators are of two types: external indicators, internal indicators. External indicators: an asset's market value has declined. Second, significant changes in technology, market conditions, economic and legal environment, which has adverse effect on the entity. Third, market interest rates have increased, and those increases are likely to affect the discount rate used in calculating an asset's value in use. These are the three external indicators. What are internal indicators? First one, obsolescence or physical damage to the asset. Second, asset becoming idle, plans to discontinue or restructure the operation to which an asset belongs, plans to dispose of an asset before the previously expected date. Third, useful life of an asset becomes finite from infinite. Fourth, economic performance of an asset will be worse than expected. These are the four internal indicators. The above indications are only illustrative and not to be taken as exhaustive or conclusive. Next, a requirement for annual impairment test in case of following assets. In case of following assets, impairment test need to be done on annual basis. Guidance on timing of annual impairment test. Annual impairment test may be performed same time every year, and also whenever there is an indication. If an intangible asset was initially recognized during the current annual period, that intangible asset shall be tested for impairment before the end of the current annual period. Next, in case of following assets, impairment tests need to be done on annual basis. Intangible assets with indefinite useful life, intangible assets under development, that is not yet available for use, goodwill acquired in a business combination. In case of three types of assets, impairment tests need to be done on annual basis. Next one, cash generating units, CGU. CGU. A CGU is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. Sometimes it is not possible to estimate the recoverable amount of the individual asset because individual asset does not generate cash flows, and if no cash flows, then there will be no value in use, and if there is no value in use, then there will be no recoverable amount. In that case, an entity is required to determine the recoverable amount for the CGU, cash generating units, to which the asset belongs to. Allocation of assets and liabilities to CGUs. There are two steps. First one, allocate only those assets that can be directly attributed or allocated on a reasonable and consistent basis to a CGU. Second, in most cases, a CGU does not include any liability, but a liability may be included in a recoverable amount of CGU cannot be determined without consideration of such liability. Example, decommissioning or restoration provision. Allocation of goodwill to CGUs. Goodwill acquired in a business combination does not generate independent cash flows. Therefore, it is allocated to CGUs that are expected to benefit from the synergies of the business combination. If if goodwill can be allocated to a CGU, then conduct impairment test for the CGU, including goodwill. Goodwill sometimes cannot be allocated to individual CGUs on a reasonable basis, but can only be allocated to a group of CGUs. In that case, first conduct impairment test of all individual CGUs without goodwill, and then conduct impairment test of group CGUs with goodwill. First one is without goodwill, second one is with goodwill. Next, allocation of corporate assets to CGUs. Example, building of a head office. Corporate assets do not generate independent cash flows. Therefore, corporate assets are allocated to CGUs or group of CGUs to which the asset belongs. If a portion of corporate assets can be allocated to a CGU, then conduct impairment test for that CGU, including corporate asset. If it cannot be allocated to individual CGU, then but can be allocated to group of CGUs, then in that case, first conduct impairment test of all individual CGUs without corporate asset, and then conduct impairment test of group CGUs with corporate asset. Next, a recognition and measurement of an impairment loss for a cash generating unit. How to calculate impairment loss for a cash generating unit? Impairment loss for CGU. Impairment loss for CGU equals to carrying amount of CGU minus recoverable amount of CGU. What is the order of allocation of impairment loss to assets in CGU? First, reduce the carrying amount of goodwill allocated to CGU, then to all other assets, including corporate assets, except those assets which are outside the scope of this Ind AS. For example, trade receivables, investments, inventory, etc. If any asset is tested individually and also the same is included in CGU, then no impairment loss will be allocated to that asset in CGU as the individual impairment test of that asset is already conducted. If the recoverable amount of an individual asset cannot be determined because value in use cannot be determined, in that case, if CGU is not impaired, then individual asset whose recoverable amount cannot be determined is also not impaired. This applies even if the fair value less cost to sell of an individual asset is lower than its carrying amount. Next, reversal of impairment loss. Impairment loss recognized in earlier years can be reversed for an asset other than goodwill if any indications exist that impairment loss has decreased or reversed. Indications of reversal of impairment loss. There are two types of indicators: external indicators, internal indicators. External indicators. First one, an asset's market value has increased. Second, significant changes in technology, market conditions, economic and legal environment, which has favorable effect on the entity. Market interest rates have decreased, and those increase are likely to affect the discount rate used in calculating an asset's value in use. Internal indicators. There are two internal indicators. First one, economic performance of an asset will be better than expected. Significant changes with a favorable effect in a manner in which asset will be used. That means there is a favorable effect regarding the usage of the asset. An asset's value in use may be greater than assets carrying amount simply because the value of future cash flows increases as they come closure. That is, as a result of unwinding of discount due to passage of time. However, the service potential of that asset may not have increased. In such cases, do not reverse the impairment loss. Treatment of reversal of impairment loss. A reversal of impairment loss per individual asset. If asset is carried at cost model, the impairment loss reversal income will be transferred to P&L account. If asset is carried at revaluation model, treat the reversal as a revaluation gain. If impairment loss was transferred to OCA, then transfer the reversal also to OCA. Reversal of impairment loss of CGU. Reversal should be allocated to the individual assets of CGU except for goodwill on pro rata basis of their carrying amount. After reversal, increasing carrying amount should not exceed carrying amount net of depreciation or amortization had no impairment loss being recognized. That means maximum amount of reversal of impairment loss can be calculated as below. First one, carrying amount of an asset net of depreciation if there was no impairment less carrying amount of asset net of depreciation after impairment, and maximum reversal will be difference between both. Above 2 will be the maximum reversal of impairment possible. Next, non-controlling interest, the impact on goodwill impairment testing. Under Ind AS 103 business combinations, an entity has a choice between two methods: measuring non-controlling interest at proportionate net assets method, and non-controlling interest at a fair value method. If an entity measures non-controlling interest as per proportionate net assets method, goodwill attributable to NCI is included in recoverable amount of CGU, but is not recognized in carrying amount of CGU. As a consequence, an entity shall gross up the carrying amount of goodwill to include the goodwill attributable to NCA. This adjusted carrying amount is then compared with the recoverable amount, determined whether the cash generating unit is impaired or not. Below is the guidance given on the allocation of impairment losses. The impairment loss is allocated between parent and NCI in proportion of their stake. If an impairment loss attributable to NCI relates to goodwill that is not recognized, only the impairment loss relating to the goodwill that is allocated to the parent is recognized as a goodwill impairment loss.